Hey everybody, welcome back to Sniper Gains. On this channel, we provide you with the best tips and tools to help you become a better options trader. Now, in this video, I will show you how I use the pre-market buy-side liquidity grab to make $90 on my Google Put contract in less than 1 hour. By the end of this video, you'll understand how to execute this strategy so that way you can make more money. All right, let's begin. Now, the first step of understanding this pre-market buy-side liquidity grab is to understand the concept. So the concept is pretty simple. Basically, when you go into your chart, you will have a zone that looks similar to this. So let's see here. You will typically have a zone that looks similar to this. You'll have a light blue or dark blue area, dark orange, and then just the regular black, right? These represents sessions. This is the daily session. This is the after hour session. And now this, which is the main focus of the video, is the pre-market session. If your trading view does not look similar to this, what you may be experiencing is you'll have to go to your session tab. So you're going to right click, you go to symbol, and then you go to session. Because there's a pretty good chance right now your account or your canvas looks like this. In order to activate that extended hour session that I'm using, you want to right click again, go to settings, go to symbol, then go to extended hours trading. Now let me explain the theory before we go into it a little bit more. So the simple theory is this. There are lots of shorts that are in this zone because from this zone, the price was pushed down all the way. So naturally, market makers know that there are lots of shorting orders right over here. Now, the way the market maker likes to play this game is it likes to take out liquidity before pushing price to go in the direction that it wants. Now you might be wondering, why do they like to do this? Number one, market makers are very greedy people. They want to make as much money as humanly possible. So the way they're going to do it is, even though these people have the right idea that the price is going to go down, right? The market makers want to enjoy that price going down direction, but they want to get it at a better price. Most retail traders got it at this price. They actually wanted to get it at this price because if they can push the price higher and short it down, they'll make more money. So the way it works is like this. I'm going to put this on replay. The price started off at around 160.82 at around like 4:05 a.m. Then it went all the way down to the pre-market low. Take a note of this because this is going to be very important as we progress through this strategy. So this is your pre-market low, okay? Now remember what I said. When you're in the pre-market zone, many shorts are located in that position. So what you want to do is you want to wait until these shorts get taken out, or what we like to call swept, before entering to a short position. Now, why did they even have a short position in the first place? It's due to what's going on in the economy right now with high inflation and the concerns going on between the Israeli and Iran conflict. Typically, in these times of uncertainty, investors tend to be a lot skittish. So their theory of shorting does make sense. However, even though it makes sense to short, the market makers still want to get at a better price. So this is what they are going to do. We're going to focus on the execution. So here we go. Keeps going. Let me kind of zoom in a little bit so you can kind of see what's going on. Okay. Now notice this is the pre-market session. As soon as we hit market open, take a look at the huge candle that's going to form. Okay. Boom. When a person sees this big candle, the shorts over here get kind of scared because this is a very big candle. And the way you can tell is there's a lot of buying pressure. There's no selling pressure to kind of balance this out. So when they're seeing that, they're kind of getting scared. At this time, when they're seeing this candle, they're starting to buy. This is where it's called the buy side liquidity grab. They're trying to buy themselves out of the position. Because whenever you short, you start off from selling, and then to get exit out of the trade, you start to buy. Now, what naturally happens when people start to buy a stock is it causes the price to go up even more. So take a look at the next 5 minutes. Boom. So the shorts have already been taken out. Now this is how the shorts were taken out of their position. Now, the next set of people that they're going to take out are the longs. And here's why. When a breakout trader sees that this pre-market high has been broken, they will naturally think that this price is going to skyrocket based on the information that I saw here with this big fat with this big fat green candle forming. They'll think like, aha, these shorts are idiots. The real move is going up, going long. However, keep in mind, what's actually happened in the market is it's still a lot of bearish sentiment. So for the people who are entering these bullish positions are really playing with fire. Because yes, can you make money during a bearish market condition? Can you be able to effectively buy calls during a bad bearish day? Of course you can. But again, you are essentially trading against the wave. You have to think of, if the market sentiment is bearish today, let me focus on taking a bearish position. For the people who got suckered in over here and that took a bullish position, they're gonna experience true pain when it eventually starts to go down. Now, let me continue even more. So you see your break, you see this retest with a hammer candle. Let me zoom in here. Okay, sorry, this is an indecision candle. So I'm going to move on to the next one. And then here it is. And that was the one. So yes, there was indecision around here, but then you see this nice bullish candle. Now the break and retest traders think, okay, yeah, this is solid because it not closed below the pre-market high. You see this nice big push. Now, I can definitely respect that perspective. However, the key core thing to help reduce these fake outs is understanding what is the market sentiment today. And since it has been very bearish, if you were to take a long position, you're essentially taking more risk and you're not really trading responsibly because you should be trading with the market sentiment at that time. So the people who entered here will eventually lose quite a lot. I'm going to move on to the next 5-minute candle and another one. And I want you to pay attention to this zone right here. This is going to be critical. This is known as your major zone for like a change of character situation. And here's the concept. If you've ever looked at any smart money concept video, they always emphasize the market structure. So in this case, you have a high, high, low. Let me use this right here to kind of illustrate that path. All right. You have your high, low, high. Now, ideally, we wanted to form a higher low and then go up like so. I know that's kind of a messed up, whatever. But it's supposed to go higher, low, higher, low, and keep going up. But take a look at what happens on the next candle. Boom. This is known as a displacement candle. So I'm going to take this out here. This right here is known as a displacement candle. What that simply means in simple terms is that it formed that change of character, which started that initial shift. And the key thing is it formed a big red candle that has a lot of space. So for example, if I go to the next one right here, you will see that there's a fair value gap. So if you've never heard of the concept of a fair value gap, the theory is simply this. The market is so efficient that whenever there's a gap in price between 3 candles, the market finds a way to fill that gap before continuing in its intended direction. Now, my assumption of its intended direction is that it's going to be bearish based on what's going on with inflation fears and what's going on in the Israel and Iran conflict. So you see, with that bearish sentiment in mind, I believe that the market is going to go down. Now, before it eventually will reach this zone right here, it will fill this gap. So let me highlight this over here. So we're going to go here, take that, and I'm going to zoom in so you can kind of see it. So you see this candle right here, and then you see this candle right here. There is a gap. For price to be balanced, there needs to be some sort of, even a wick that fills this gap, kind of like this. So let me take this line over here. Should be an extended line. Let's see here. It needs to fill that gap, kind of like so. In order for price to be balanced, it needs to do something like that. If it doesn't, then that means that that is a gap that the market will do its best to fill before continuing in its intended direction, which in my assumption at the time of the trade is bearish. So now with that being said, take a look at what happens next. Okay, I'm gonna go to the next one. Wait for it, and then boom, this is your zone right here. So I'm gonna take this out. So it has filled this gap. Now, at that time of entry, I had entered as soon as it hit this gap. This is me fading that move, meaning I'm not waiting for it to close here. I'm taking that position right away because my assumption is it's most likely filled this gap with the intention to go down. Now, for my entry, you will see that that's around 920. If I take a look at my Robinhood, I took this trade. Let's see here. Taking a look. Give me a second, guys. Okay, so that was 419. Yeah. Oh, 412. Sorry about that. Where is it? Okay, so executed at 412 at 9:21 Central Standard Time. Over here on the chart, it will be 10 because this is based on the New York time slot instead of where I live in Texas, which is Central Standard Time. So that is basically where I entered. And you can see this is real. This is not fake or manipulated. You can see the contract. You can see the liquidity fees. This is the real deal. Okay, so I entered at 191. Okay, so now I'm going to zoom out of this position and then see what happens next. So after entering that position, I set my target at the pre-market low. And here's why. Just from experience, I've learned that the zones that typically have a lot of the opposing liquidity, which is sell side, aka the sell stops, tend to be the pre-market low, the low of day, or equal lows. Since the pre-market low was like the most reasonable target, because it's like right here, I decided to create the risk to reward ratio to be a 1:2, targeting that pre-market low. So my stop was right over here, and my profit target was at the 158.96. So this essentially acts like a magnet. That's the best way to describe it. When you take out the buy side liquidity, it will typically go towards the opposing liquidity, which will be the sell side. So that's one magnet that's pulling down price. The second magnet that's pulling down price is this large fair value gap. Remember, the market typically likes to fill these gaps before it goes in its intended direction. Now, since its intended direction, which we can all agree was bearish that day, it noticed that there was a large gap that needed to be filled. So now it's going to start to fill the order. Keeps going. keeps going, keeps going, 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 and boom. Note the time. Was it 11:05? Make sure I got it in. Okay. 10:08. Remember, I'm 1 hour behind. So essentially, that's where it hit the price. And I was able to lock in that profit at 281. And again, this is real, regulatory fees. This is the real deal. That's how you guys use the buy side liquidity grab. I thought the video would be super long, but I guess it was shorter. However, I feel like this is a simple entry model that makes sense. So just as a simple summary, whenever you're doing the buy side liquidity grab, mark out your pre-market high, mark out your pre-market low, wait for price to sweep that high, form a nice displacement candle, enter on that fair value gap, and let it ride all the way. Now, one of the key things that I will say from my psychological perspective is that you need to trust the system. If you start micromanaging price, like having partial profits here, maybe partial profits here, you're gonna hurt your P&L in the long run. And the reason why is that with this stop loss, naturally you will want to wait until it takes you out, but you're not willing to necessarily do the same thing on the other hand. If you are not willing to do that, then it's gonna hurt you in the long run. So my recommendation is, with this new strategy, first test it out on a paper trading account. There are many accounts that I highly recommend. You can be able to use Webull. Webull is great because it allows you to paper trade your account without having to use real money. So that way you can gain the confidence in order to use it. I'll include that link in the description. And also, I highly recommend that you take advantage of Robinhood as well. The benefit of Robinhood is it's a great brokerage because just like Webull, they both do the same thing. You can open a cash option trading account. The benefit of doing that is you can take as many day trades as you want without worrying about the pattern day trading rule. And the second reason why I recommend both Robinhood and Webull is that you can never get margin called on a cash trading account. This is going to give you peace of mind, especially when you trade options, because there's nothing worse than losing the trade than owing your brokerage thousands of dollars for not practicing good risk management. I know it's not as sexy because most people like leverage, but in the long run, this will give you peace of mind to actually execute those trades, to actually let that trade hit the target without the fear of getting liquidated. So highly recommend you take advantage of it. I'll include both links in the description. If you enjoyed this video, subscribe to the channel for more content like this. And as I always say, trade responsibly in order to keep sniping those gains. I'll see you on the next video. Peace.